And the ongoing tariff fallout is impacting the U.S. economy. GDP shrinking by 0.2% in the first quarter. That's according to revised information that confirms the first contraction of the U.S. economy since 2022. Okay, let's take a closer look at what is happening with the U.S. economy. Joining us, Brian Huckstep, Chief Investment Officer at Advyzon Investment Management. Brian, welcome. Thanks for joining us.
Thanks for having me.
I want to get your reaction to this information. Slight revision upward, but slight. And what pushed the economic growth down for the first time in the first 3 months of this year? Your thoughts?
Like the previous segment said, the biggest component was the imports. So many people rushed out, and companies, businesses also rushed out. When the tariffs were announced, and they really started being announced in mid-February. So it wasn't just April 2 when the big large tariffs were announced, but we started hearing about aluminum tariffs Feb 21, and the market started pulling back. So the S&P 500 hit its peak Feb 19 and has been pulled back till April 8. And during that period, the major news factors were tariffs. Right. And so it's not just that consumers went out and purchased things. There are typically, economists talk about 4 components of GDP: consumer expenditure, government expenditure, investment, and net import exports. And corporations, CEOs and CIOs that I talked to and listened to, talked about being hesitant with the uncertainty around tariffs that started mid-February. Some CapEx was cut. And that's problematic because that uncertainty is still here. Mm-hmm. So when we think about, are these things going to continue in the next quarter and maybe a quarter after till we get certainty, that's quite possible.
Yeah, uncertainty really has been the trademark of this, with the courts now wavering on the legality of Trump's tariffs. What about investors? How do you think they should be thinking about their trade exposure, especially with the volatility in sectors such as manufacturing and tech?
Well, manufacturing is really a two-part story. Some manufacturing that happens in the U.S. with primarily U.S. parts stands to have a really good time with tariffs. I mean, the whole point of tariffs is to give a boost to U.S. manufacturing, to bring some of that back home. So if you're in an industry, I grew up in Michigan, have a lot of relatives that work in the car industry, it stands to do pretty well, even though some of the imports are going to get tariffs. Hopefully demand rises enough to more than offset that. So some of the manufacturing could be doing pretty well. It depends on how much import and export they do.
Okay, and the big, beautiful bill, as it has been called by our president, and its impact, especially on the deficit. The White House is saying, look, it is not going to add $3 trillion to the deficit over the next 10 years. But economists are almost united in saying that it will.
I am singing from that hymnal. I think it will. During Trump's first presidency, he showed that he wasn't afraid to run up the deficit. And of course, he had to deal with COVID. That was very unfortunate. But, cutting taxes is something that he very much values. And so with the big, beautiful bill, there could be spending cuts, there could be tax cuts, but he has shown a predilection to reduce taxes more than cutting spending. Now, DOGE did some heavy lifting. They made some cuts, and that's potentially another factor that happened with the GDP. That government spending part, the DOGE cuts weren't that large in relation to the entire deficit and in relation to GDP, but they were there.
Yeah, they were.
And those cuts stick with us. Those things haven't bounced back. So that's going to stick with us in future quarters.
Yeah, and I think there's the argument that we haven't felt the fallout from that yet with all the unemployment, especially in this region where we are right now. But moving on, one bellwether is the housing industry. And a new report out shows there are a lot more people selling than buying right now, as many as 500,000 more homes up for sale compared to people looking to buy. That's not a great equation. What does it tell you?
Well, we know with mortgage rates have not come down. I think there were a lot of people that were hoping we'd see mortgage rates drop from 7 to 6 to 5 and, maybe go back to 4, over the long run. And that just doesn't seem to be happening. In fact, with concerns over the deficit, we've seen the longer end of the curve, which is primarily linked to mortgage rates. We've seen it go up so that the yield on longer term bonds has risen recently. So there's kind of, no relief in sight for those mortgage rates. So if you're looking to buy, that's problematic.
And that leads right into the Fed and questions about concerns for the second quarter: inflation, stagflation, relation. And I'm curious about the optics, especially when consumer confidence is tanking at a near all-time low, and the president summons the head of the Fed for addressing down in the White House, demanding Jerome Powell cut interest rates. It's not a great optic.
It's not a great optic, and I don't think he's going to fold. I think Jerome will do what he needs to do to, work on his two mandates: employment and inflation. And employment seems fine right now. Inflation is still a little bit high. I don't see any rationale for him lowering rates.
Right.
Yeah, that's problematic. That is a big problem.
And also problematic, the fact that the U.S., its credit rating has been downgraded by major agencies. That's the kind of thing that could haunt moving forward very significantly.
Yeah, our deficit has crossed $107,000 per U.S. citizen. So it just keeps climbing, and there again, no end in sight to that increase. And so that debt rating cut was, I think warranted. It makes sense because, the percent deficit and debt of GDP is just climbing and climbing. And, Doge had a really tough time making any cuts. So again, no end in sight to that, but that is problematic. And the interest on the debt is climbing at a pretty high rate. When you take that 107,000, multiply it by about a 4%, average maybe cost to the debt, that's $4,000 per person we're paying each citizen, and it's double that if you look at taxpayers. But that's just gone. That's just paid out to cover the debt, and we've got to slow that down.
Okay, good stuff, Brian. Thank you so much for your insight. We hope to have you back again and maybe a little brighter set of numbers in the next quarter. Thank you.
Thank you.